back to the Capital Mindset Show, guys. We're your hosts, Austin and Fabio, and today we have a very, very, very special episode for all of you guys here today with the one, the only, the stock on everybody's mind that's huge on YouTube right now, and that stock is Tattooed Chef. So today we've put together a comprehensive due diligence off of a viewer request from our website, and we've put together a comprehensive due diligence whereby we are analyzing TTCF from all fronts and just kind of giving our opinions on the stock, as well as some interesting things that we found. So before we start, I mentioned before that this stock is actually a viewer request. And to request for us to potentially look into a stock for you guys, we would recommend that you guys go to our website at capitalmindset.org. You scroll down to the bottom of the page, and then you go to the Contact Us form. Now, always, we are not registered or licensed financial advisors, so we will not be offering financial advice. However, we would absolutely love to kind of look into any stocks that you guys are curious about and just kind of tell you what we think about that said stock. So now, Fabio, kind of diving into this, what were some of your preliminary thoughts regarding Tattooed Chef coming into this due diligence episode today?
All right, so to keep it brief, because we already did the preliminary analysis, basically it's a food company, caters towards vegans, tries to market itself as healthy, and tries to tell its investors that it's vertically integrating. And when I say the word try, I don't mean that they're failing at it. I'm just saying that's what they say they're doing. And they're also trying to spur up some excitement around the brand itself. I know that, for example, they're in Target, Costco, Sam's Club. Those are the main stores that they're in. What else do we know? So other things we've discussed was the sales growth seems good. It's there. It's about 50%. Looks like for the past year, projected another 50-something% next year. Whether or not that's enough, we will find out. On our preliminary analysis, we saw that their balance sheet looked very clean. Their current ratios look very clean, all of that. So basically nothing screaming, oh, bankruptcy next year or anything like that. What else? Did we see anything else? I don't remember in our preliminary analysis. I think I covered almost everything. Do you remember anything?
Too. Not exactly, but something that I find kind of interesting is I see a lot of people specifically talking about online, the business fundamentals with Tattooed Chef.
Yeah.
So kind of what I was doing, like during my due diligence, was I was kind of looking into how many SKUs they're getting in per store, and it's averaging around 4 to 6, with some of those prices in the low end of $3.50 in stores like Walmart, and then some of those prices as high as $8, roughly $10 at the very extreme. Now, what's interesting about this is that I've heard some people on YouTube say that they expect Tattooed Chef to get around 40 SKUs a store, and right now they're averaging around 4 to 6. Now, this is a new company, so there's plenty of room for growth, but because it's a new company, a lot of what you're seeing on YouTube is based off of personal, subjective assumptions. And that was really what I found interesting when I was looking at their SKU count, because if Tattooed Chef really wants to be a player,
so you're telling me I can't assume things?
Well, you can assume whatever you want. You just have to have a justification for it, Fabio.
What do you mean?
Yeah, you got to have a justification for it. If they're averaging 4 to 6 SKUs, you can't suddenly say 40. Well, you can, but it's all about an educated assumption, right? Fabio, you always tell me about educated assumptions, right?
No, man, I don't know what you're talking about. I totally think, like, look, if I say they can do something, I'm going to buy it because I say they're going to do that thing.
So what if I was...
They're going to go into cloud computing.
They're... Interesting. Well, you've heard it here, folks. That's the end of the... No. We're just kidding. But
No, Tattooed Chef, cloud computing. That's the title.
Cloud computing. It's going to become the next Tesla.
Yes. No, yep.
Anyways, back to the point at hand.
More serious.
In essence, if Tattooed Chef really wants to become a player in this, they need to be increasing the amount of SKUs they're getting in per store. Because if they can't, then those SKUs are just going to end up in the back of the frozen food aisle, which would be detrimental to this business specifically. Now, something interesting that I've kind of found, Fabio, and it's something that you and I have sort of spoken about on Strongman Personal Finances channel, as well as our own first preliminary analysis video of this, and that's kind of the scalability issues facing Tattooed Chef.
Yep.
And so something that's really interesting, and I found, is that they disclose in their 10Q that a lot of these costs will come from freight and containment costs, and that's due to inflation. However, they're also getting a lot of their supply from Italy. So when that happens, you're typically going to be having international shipping. And I'll kind of put this up here now, but these are 3 strategies that I'm really that I would envision and I would want to see Tattooed Chef doing to mitigate these costs, because mitigating their top line costs on their cost of goods sold line is crucial to their business, because it's crucial for pricing. And Fabio, would this be a correct assumption to say that pricing is incredibly important in a sort of business such as Tattooed Chef?
Oh, entirely, because the profits are determined by what pricing they can get on that distribution channel, because that goes into the cost of the business and then will translate to how much money they end up keeping on the bottom line. So yeah, they need to stabilize those costs. If they don't, then they're going to be leaving themselves wide open to inflation. So anyone out there who believes inflation is coming, and this episode's not about inflation, but if you're one who believes that, then you're opening yourself up to a lot of inflation risk here. If you're buying up a Tattooed Chef stock. So you need to be aware of that and say, okay, what is the company doing to mitigate this? And do you believe they're going to be successful at that? So that's something you have to think about and then account for in your pricing.
Mm-hmm. So now to kind of move on from there, Fabio, I've also heard some other people say too, some large YouTube creators say as well. All right, so Tattooed Chef is now in such a strong cash position, Fabio,
which we have confirmed.
Why would they need to then dilute shareholders? And so the thing about that is that too also rests on an assumption. And something I found interesting about this is for this year currently, they are currently negative on their cash flows from operating activities. But then most of their cash came from redeeming these stock warrants, which during their SPAC, they engaged in what was known as mezzanine financing, which is typically it's right beneath equity, pure equity financing, and it's above debt financing. And what that usually allows someone who goes into a financing arrangement like this is it gives them high returns, but a lot of risk involved with this. And then the other thing is that there's a lot of stock warranties involved with such financing transactions. So they redeemed 15.3 million out of 20 million. And now that actually corresponded under their statement of cash flows here, which you guys can see here. And so now I kind of want to pick your brain, Fabio, because they've also disclosed here that they have 1 billion shares authorized. They have 1 billion shares authorized. So now I kind of want to pick your brain, Fabio, and I really want to actually see what your thoughts might be regarding this. Do you think that maybe in the future they might be diluting shareholders?
Well, I'll point to Michael Burry. So something that Michael Burry actually said in the year 2000 in a lot of his letters was being careful about businesses that buy back shares and still have a bunch of authorized shares. So despite buying back the shares, if they don't actually delete those shares, then those shares could come back in the future. So it's like a little trick they can play. I'm not saying Tattooed Chef's playing that trick, but you have to be aware, okay, well, it's 1 billion shares authorized, correct, Austin?
Yes.
Well, then that's 1 billion shares that could just pop up in existence at any point because they're authorized shares. They're not in effect as of now, but that does tell me that the board of directors has that ammunition available. And why would they have the ammunition available if they weren't going to use it? If you were going to say with a certainty that they're not going to dilute any further, then there would be no authorized shares in excess of the ones that are outstanding or circulating in the market. Then in that case, you can make an argument saying they're not going to dilute shareholders further because they would have to authorize new shares and that would take a vote. But there could be a bunch of reasons why they do issue shares, and it's not true at all to assume that they won't. And that could be to pay management. So that's the least bad one. Then there's to fund operations. But you got to understand that a good CFO, why would they want to issue shares? Well, a good CFO, their
lowest cost of capital.
Exactly. Yeah, that's their primary purpose in the business, is to allocate the lowest cost of capital in order to grow the business, whether that be debt or equity raising or any form in between. They have to find that. So if the equity is expensive, you want them to be issuing shares in order to get that rather than issuing debt, because maybe the debt is more expensive than issuing the equity and vice versa. And that's something you can calculate when you get to the WACC, when you calculate WACC, and you can
Weighted
see what are
average
the
cost of capital. That's
exactly.
what it stands for.
And you can see what are the different weightings and what are the costs. So you want the most weighting to be in the lowest cost, and that lowers the WACC. And when you lower the WACC, that enables the business to grow better. So the CFO, if they're not doing that, they're not doing their job right. They're doing you a disservice, actually, if they're not doing that as an early investor. And if you're truly a long-term investor, you actually want them to, again, get the lowest cost of capital to grow the business the most. So with that being said, that's exactly why shares can still be diluted, or companies will dilute their shares despite not necessarily needing to. It's all about the lowering the cost of capital.
Yeah.
So anyone who says that doesn't really know what they're talking about.
And so now, kind of moving on from here, Fabio, I've also heard as well, a lot of people say, and these are the bulls, these are the people that are seriously bullish on Tattooed Chef. They've said that Tattooed Chef could eventually get to a 20 billion, 40, 60, or even, get this, Fabio, an $80 billion market cap. So now let's kind of go through the model now and kind of plug in those assumptions and sort of see if that's even feasible for something like this.
So in order to do that, we need to first plug it into the regular model, and then we'll use my the calculator I call the perspective calculator. It'll put everything into perspective as to what it is we're assuming. So I guess in the first assumption, we'll say a 20% rate of return. Well, we won't assume any buybacks, so this part doesn't matter. And then we will assume on the low end 40%. And again, I think I said they grew up 50-something% last year. They're expected to grow 50-something% again this year. So then we'll make our assumptions here, going up as we go up to 80%. And then we got to put in our ticker. And then let's assume in the middle range of the industry, 7%. So that's between 5 and 10%. Actually, let's be bullish. Let's say it's going to be 10%. You know what? Maybe I'm extra bullish. Maybe they can do 15%. I don't know, Austin. Let's do 15%. So at 15%,
on assumptions.
It's all resting on assumptions. So let's say they're able to outperform the industry average, and they're able to get to a point where they're at 15% profitability, right? And actually, let's actually quickly make sure. I'm skipping over to here because I just want to look here, net profit margin. So I'll actually come down here to see this. Okay, so Conagra is not too nice either, but let's go back here. So, it's around 15. We'll do a little bit. They're up there. All right, they're up there. So at 15% longer term, what we can see here is the different growth rates that we would have to assume in order to achieve this. Now, 20% rate of return, that's about 500% over 10 years. That's nowhere near, or that's half the returns of what some people have been predicting, as far as saying it will 10x in 10 years. Okay, so 10x in 10 years is actually a compound rate of return of 27.1%. And that's the assumptions we're going to have to make. So let's use the perspective calculator to put everything, like we said, into perspective. So let's actually take a little zoom out here so we can see everything. And this again, 27.1 gives you that 1,000% rate of return, or 10 times your money over 10 years. And now we want to take a look at the perspective, right? And what that means is, what are you saying that the business will grow to by that time? So if you assume a 10x, what you are assuming based on that, compoundedly, is a market cap of around $16 billion. Okay, so is that rational? That's a compounded, so compounded rate of return. Is that rational? Perhaps, yes. So what I would say from there is, we're not assuming any buybacks. Let's assume they do a buyback. Let's say they do a quick buyback. You can see that comes down to account for that buyback. And then let's change that up to say a dilution. which is probably more likely. So let's do a small that let's keep it at 1% dilution. So you see how it's actually higher now, but that's because there's more shares, and we're assuming, right, that the share count's increasing. That's actually worse for the investment, because pay attention to these prices. So again, I'll say no. While the market cap is smaller, the returns will be, or sorry, the prices do get lower for the buy price. Again, when I put in a yes, so I want to show that there's a disconnect between this and the buy prices. It's actually a inverse relationship when you account for share dilution. Okay, so just because the market cap's getting bigger does not mean you're better off. It's not true. And then we're going to ignore the inflation calculator for the market cap, but that's something you can talk about later. What I want to focus on is now the different assumptions. So that's a 10x. That's what a 10x looks like. And these are the growth rates you'd have to assume. If you assume any form of share dilution, none of these growth rates suffice, which is kind of getting there.
Actually, let's kind of assume share dilution. And then for some of those growth rates, let's find a growth rate that would suffice, Fabio.
Okay. And by the way, I want to highlight, I'm being pretty bullish on the long-term profitability percentage
and the growth rates. That's incredibly bullish on the growth rates.
Let's knock out the smallest one. Let's say 90. I think 90 will do it. Yeah, 90 will do it. So you see the difference between 80 and 90 is significant. So let's actually then lower that down to 85. Let's lower that down to 82. 81.
Nice.
And then 80.5. So around 80.5. If I can get 80.5% growth rate averaged out for 10 whole years, then I can justify making an investment if I want, or I am expecting, a 27.1% rate of return for 10 years every year, compounded. And that would 10x my money over that time period. Now, Austin, we kind of looked at the perspective of what we're demanding from this, or what some people have demanded from this. We got to close to $20 billion, which was on the low end of that trifecta or quadfecta assumptions of market cap. If we were to assume a 80 billion on the high end, that would be 50% rate of return for 10 years. If you were assuming it's going to get there in 10 years, which would be pretty crazy.
Yeah.
It'd be a very good investment if such a thing occurred. But let's go to the key ratios, because I want to actually start comparing this with the industry averages. So here we can see what Conagra is at. So Conagra is actually already there. They're a $16 billion company. And what we discussed in the preliminary analysis video of Tattooed Chef was the health of the balance sheet relative. Well, we haven't actually compared it to Conagra, but it appeared to be extremely healthy. And you can see here from the IPO that they did, they raised capital and they basically paid off a lot of their debt. So that they have cash on the balance sheet. To the Bulls' credit, they have a lot of cash. Their balance sheet's very healthy. They're not going to go bankrupt within the next year or so, or it doesn't appear to be that way. And then gross profit margins. Well, here's where we started to see negative assumptions. So they are not at the scale of Conagra at the moment. And there's a couple other businesses we're going to compare. So anything that stands out to you, Austin, at the present moment versus Conagra versus Tattooed Chef, because again, we've already covered Tattooed Chef in the preliminary analysis. We're just comparing it to Conagra.
Looking at Conagra, they're definitely better on that top line cost. So that kind of plays into exactly what I was talking about earlier, Fabio, where I would want to see as an investor, Tattooed Chef continuing to mitigate those top line costs.
So just for the audience, can you speak? Can you bring the microphone a little closer?
Is this good?
Yeah, around there.
But so as I was saying, I would want to see Tattooed Chef mitigate those top line costs. If I was invested in this stock, that would be exceptionally important for me to look into. I would literally be there on earnings calls being like, how are you mitigating your top line costs? I want to know. Tell me how you're mitigating your top line costs. I would be very passionate about that because that is integral to this business. And then what I'm also noticing too is that net profit margin, Fabio.
Net profit margin. What are you seeing about net profit margin?
So the net profit margin for Tattooed Chef is a negative 104 for the trailing 12 months. And then for Conagra, it's 12%.
Everyone
So
out
that
there is
also
going to shout at you saying one-time expense.
Yes. I'm sorry. But that also kind of shows me too, Fabio, that there might be some scalability issues in terms of their operating expenses as well, which I've actually heard. To the credit of the big YouTubers, they have noted that there are scalability issues, at least in the short term, because the CEO has said, and it's actually disclosed, and I'll provide that here for you all as well. It's disclosed that they're spending a lot of money in their marketing right now because they're trying to grow their brand, which is great. However, the question remains, Fabio, is this a short-term scalability issue or a long-term scalability issue? What do you think?
That has yet to be determined. That is something that will be very difficult to just predict willy-nilly. You have to then, so basically what we're getting at, this is kind of like the lesson here, is if you somehow have these assumptions, right? What you want to do is pay the right price in case that you're wrong at some of those assumptions. As we were just noticing in the discounted cash flow model, just a couple percentage points change in those assumptions on the growth rates of the cash flows can adjust the prices by such a drastic amount and change the results that you're going to experience. So you want to have a certain level of certainty. You don't want to play around with that and just assume, oh, everything will be okay. I think this, and then I'll pay whatever and that's the price. No, you actually want to be very careful as to what price you pay. You could be right. And if you're 100% right on your assumption, there's no room for error, 100% right on your assumption, you could do good. All right. So for example, if all those numbers occurred and to the T, and they did grow at 80-something% per year on the underlying business, or maybe somehow you predict that in 10 years, the market's going to pay a hefty premium, like, I don't know, something crazy like 100 PE for this business. Okay, fine, whatever. But you're assuming that. You have to come to terms with that's an assumption. And if you're okay with that, then, it's your money at the end of the day. But that's the point. It's about the price you pay. So if you are not certain about your assumptions, you discount that in the price that you're paying for it to account for those uncertainties. And I want to take a look real quick here. So something with this industry, and we'll see with the other businesses, is there this unique measure we do here, earnings quality. It's not that good, but Tattooed Chef during the right here during this, it's been pretty much negative. So again, we're assuming they one day will be positive. EPS, okay, one-time expense, huge spike, so we'll give them that. And then the EPS for Conagra, it's an established company. What we do notice is that there is a downside surprise for Conagra. We'd have to do a whole due diligence video on Conagra to find out what that is, but that's not the point of this video. It's just to quickly take a snapshot look at the competitors. Book value for Conagra is obviously going to be larger than Tattooed Chef for now. And I'm trying to be devil's advocate for the bulls out there to be, just fair and unbiased. Then let's take a look at some of these performance metrics. So the cash conversion cycle is concerning. It shows they don't have much power with whoever they're dealing with. It means that they're having to pay up front basically, and then they're getting the cash much later for their goods and services, while Conagra is taking a lot longer. And we'll see this theme actually with the bigger companies. So that's a little bit of a spoiler alert. The bigger the company, the more power they seem to have with the people they work with. And then, so we can see, we already kind of talked about these ratios in the preliminary analysis. We're just trying to compare it again. So we can see that Conagra's ratios in the performance ratios are better. They're just objectively better in almost every regard. So then I would actually, let's start bringing in the other two players. We have two more players. Well, we have three more players, but two more that these are bigger than Conagra and Tattooed Chef, and they're General Mills and Kraft Heinz Food Company. So let's do a little bit of a zoom out so everyone can see the companies. So anything stick out for you, Austin? Again, between General Mills, Kraft Heinz.
Kraft Heinz has the highest current ratio. Also the lowest total debt ratio, and has the highest gross profit margin.
And
That's kind of where my
I'll
mind
give
goes
everyone some
first.
color. And so, because I know a little bit about all these companies, a little bit. So for example, General Mills did an acquisition of Blue Buffalo, paid a hefty sum. Kraft Heinz has been trying to get through a restructuring that we can do a whole video on that and what happened, what bad things happened to Kraft Heinz. You can kind of see here the scalability difference. So again, Tattooed Chef, the bulls will say it's early in the game. They're going to scale. Okay, fine. Now let's look at Conagra and General Mills and Kraft Heinz. You want to see them, if you're a bull, you want to see them inch closer and closer towards something like this. Okay. And if the argument is they're vertically integrated, then maybe even higher. Okay. Otherwise, something's off. Something's weird. Operating margins, you can kind of see that for this industry, they're very low. So you kind of want to see that edge closer to here. Net profit margin, again, it's a low margin business. And same thing with ROE, ROA, you should expect that. So let's take a look down here. So again, looking here. Oh, and I wanted to highlight back here before we leave here. These are the market caps of Kraft Heinz and General Mills at 37 and $44 billion respectively. Or not respectively, because I said Kraft Heinz first, but going here. Does anything stick out here? I noticed that for mostly all of them, their GAAP income is greater than their cash flows for all of them. That's unfortunate.
And I know your thoughts on that, Fabio.
It's accounting shenanigans. Okay, so here we'd have to check this out because I know for a fact that Kraft Heinz is trading lower than $40 a share. So that would be its own video of investigation and see how management is coming up with this book value. But there might be some issues with that book value. So take that with a grain of salt, especially with businesses like this. Businesses like this, I don't care too much what they have to say about the book value. All right, so on the last one, the performance ratios, remember how I said, Austin, that we will see with the bigger players a better cash conversion cycle? Well, a negative number basically means that they are paying whoever they're working with, whoever they're working with the shipping, anyone down the chain in the supply chain, they're paying them much later after they get the cash. So General Mills of these four has the best. Tattooed Chef has by far the worst. And you could say they're just starting out, they're just building their relationships. Okay, fine, sure. Conagra has been in this game for quite a long time, and it's still not as good as General Mills and Kraft Heinz. All right. And with that, we're going to bring the big boy into the game. And
the one, the only, Fabio, the one and only.
Yes.
Pepsi.
And that is PepsiCo. So we're going to have to do another adjustment. So with PepsiCo, what we can see here is a disappointing current ratio and disappointing cash ratio. But let's not dismiss it entirely because Pepsi's a very well-established company and probably has the cash flows to back it up. Now that being said, if the cash flows dry up for whatever reason, it could be a problem. Okay, but probably not going to happen. I put it on the lower end of the probability. And you can see here, these two larger players also have a similar situation, with Kraft Heinz being the only one with the positive current ratio. This is concerning. I know that PepsiCo, for example, has been issuing tons of debt to buy back shares. So that's been a lot of their strategy in order to kind of try to spur returns. And so they have the worst of these. And then gross profit margins, it's phenomenal. I mean, but why? Why do you think, Austin? Has to do with the drink.
Pepsi
Drink.
Pepsi.
Yeah. It's a huge margin business. If you look at Coca-Cola, margins are great. So Pepsi sells drinks, so that's not fair. We can't compare them in that regard. And then that extends to everything else, all the other percentages down here, we can't really compare. It's like its own league per se. So it's a phenomenal business.
So Fabio, if I can stop you for a quick second, you said earlier, and I ask you this every single video, you said earlier that in this particular industry, book value is not so much of a concern to you. Why is that, Fabio? For maybe some of our new audience, there's a common misconception that book value is in and of itself a really, really good thing, which it is for some industries. And then some other industries, as Fabio just noticed, it might not be as important. I've seen people X investments in respective industries that Fabio has said where book value might not matter. itself, but these people will exit because it has an incredibly low book value. So here, Fabio, why is it that book value is not exactly something that really matters all that much to you in this particular industry, Fabio?
To simplify it as simple as possible for the audience, because you don't know if it's accurate. Sometimes it can be very difficult for you to know that it's accurate. So you can calculate your own book value, but again, some of the things, depending on how they value certain things, you're relying on the assumptions of management. Depends on the business. So for example, Austin, the accounting hat, put it on. Level 1, level 2, level 3 in terms of valuation. Which one do you have to be careful of?
Level 3, because
Level
those
3.
are unobservable inputs. Level 1 are legitimately quoted prices. So for example, just to give you an example, an industry where Fabio would be he would pay close attention to book value would be the insurance industry, which we can make another video all about the insurance industry, because we love the insurance industry. And most people don't like the insurance industry. We love it. But anyways, back to the task at hand here. So you kind of get an idea of how Fabio is kind of unconventionally almost approaching certain industries and sort of taking what people hold as conventional knowledge, and they apply it broadly over all industries. But Fabio is really kind of segmenting his thinking industry by industry, which, Fabio, wouldn't you say that that's important and that relates to the idea that investing is a multifaceted cake?
Yes. So it's always a saying I say, investing is like a multi-layered cake. So every issue, it's not just one layer, it's more than one layer. And you got to get through all the layers to really kind of understand everything. And even when you think you've gone through all the layers, there's more layers yet to go. So that being said, it's like with book value. If you apply book value as a blanket measurement for everything, you're going to make mistakes. It's an amateur mistake to then say, oh, if this industry book value matters, then that industry book value also matters. Like, no, it depends industry by industry, and you have to make those judgments. As you learn, you'll start to notice that, yes, it matters for this industry, but not for that industry. So in this industry in particular, I don't pay attention to it too much. For example, I think Kraft Heinz is the worst of these big companies here, and they have the highest book value. So if I were to go just by book value, I'd say, oh, Kraft Heinz is a buy. Not necessarily. There could be a bunch of other problems associated with the business that you're not really thinking about. And that's in terms of the quality. I actually, maybe if we did the research and we find out Kraft Heinz might be a buy now, I don't know that. But what I'm trying to say is the book value alone is not going to tell me whether or not I should put capital into Kraft Heinz. So I think that pretty much covers this section, because there's not much else. I think Pepsi is the highest quality here because they have the highest earnings quality of everyone. And yeah, it just makes sense for me. For me personally, it makes intuitive sense that Pepsi here is the highest quality. They're just not at I don't think they're at a good price, but like if all of them were cheap, if all of them were equally cheap, I'd rather get Pepsi. But you hear that word I just said, all of them equally cheap.
Okay. And so that's kind of the important thing that we really like to harp on here too, that at least the way that we look at it in Capital Mindset is investing is where you want to own businesses at great bargain, typically low prices.
And take a look at that, Austin. Take a look at cash conversion cycle for Pepsi.
Wow.
How much power.
They are bullying. They are bullying people. My goodness, that is insane.
A tremendous amount of power in this industry, and their inventory turnover isn't as high, which is interesting. The best one actually is General Mills, and Kraft Heinz comes in right past them. And their day sales of inventory isn't the best, but that cash conversion cycle is insane. That's indicative of a very powerful company. If you work with them, if you're contracted by PepsiCo, you are letting them do whatever they want to you because they're such a good customer. The contracts of PepsiCo are probably so lucrative that you're willing to give them a ton of concessions and flexibility on payment because that paycheck will be huge. So PepsiCo is able to get away with that. And you can kind of see that with the larger companies, that's the case. So Kraft Heinz and General Mills are both very large companies too. They're not as big as PepsiCo, but they're still very large in their own respect. So that kind of summarizes the ratio comparison. And to finalize some of our thoughts on Tattooed Chef, what do you think right now, Austin, was some of the highlights that kind of stuck with you the most? And it could be from the ratios or the growth rates or the perspective calculator.
I would probably have to say both the growth rates that we had to assume in order to 10x the investment.
Oh yeah.
And then also, funny enough, Fabio, I was really surprised about the SPAC process. That was just really interesting to me to kind of delve into that and just kind of get into how that was financed and everything. Because I think there's a lot of other content creators that didn't really necessarily understand why certain things were happening inside of Tattooed Chef as it related to that SPAC. But in essence, as I'm getting back to what I'm trying to say, the growth rates that we would have had to have assumed in order to 10x our money was, in my opinion, unrealistic, Fabio. Now, what do you think?
Yeah, and I'll actually add to that first point and then segue it into the second point. So to the first point, the creators that fail to sometimes recognize or identify the many layers that is investing, the investing cake, what happens, unfortunately, is their argument gets lost. And so, for example, if I said a full paragraph of words, and in anywhere in that paragraph, I said something silly or ridiculous, it can discredit the remainder of the paragraph. And while that might be a logical fallacy to do that, or to dismiss everything else and say, oh, everything is wrong because that one thing is wrong, then that is not what the audience will see. The audience will just dismiss it regardless. That's just how people are, right? It's just, you have to accept that. So when certain creators criticize this company, and these are some of the larger creators that criticize this company, they might mention something that they didn't catch, and then the audience can discredit their entire argument while they may be right. So segueing back into point two, they were right in that the price currently, you're basically have no room for error, right? So if we just I just want to go back for that visual. If we go back to the price model, if we wanted to get a 10x return on this investment, right? Assuming that we wanted that, we would have to assume 80.5% or greater return, growth rate. Yeah. But I'm also assuming a decently high profitability percentage on those sales, on those revenues. So if I said that was 7%, well, that changes everything. That's in the mid range. If I said, the average of the industry around 10%, you see how that these assumptions, yes. And let's be a little more conservative. Let's not even assume the buybacks, or maybe we assume the buybacks. I'm sorry. Let's say we assume buybacks instead of dilution, and let's go a little crazy with it. You see, it's still, these assumptions can get pretty crazy, and I personally wouldn't feel comfortable. There is a price that I'm willing to pay for anything, pretty much, right? You can discount almost anything. If our audience might know, the only thing I won't pay for is something that I cannot own, which is a Chinese VIE. But aside from that, everything else, if I can own it, then I can discount it. And if I can discount it, I can figure out like a price. I can figure out something where I can kind of adjust my risk and my assumptions. For this thing, my assumptions, while I do actually own it if I buy the shares, that's not the problem here. For this, I have to assume a tremendous amount of growth. And if it even changes by even 10%, I'm not gonna do okay. I'm not gonna do what I expected. Now, let's assume a market average rate of return, because I think we didn't, and we're not going to assume those buybacks. So this is probably, if I'm being honest to the audience, and this is like where I'm going to leave off, this is where I actually think Tattooed Chef is priced for. So I think that they're going to grow substantially for the short term, or they can, and then they're going to slowly not fizzle away, but it's going to slow down the growth. It's going to keep growing, but it's going to slow down. So I'd say they'd probably, and this is still tremendous growth. 40% for 10 years is a lot of growth, Austin.
Yeah.
A lot of growth.
Incredibly steep growth rates.
Yeah. So this is a growth company still at 40%. I am not, saying, oh, it's no longer a growth company. So let's go on the high end, 60, and then 40, 30, and then 20 on the lowest end. So for example, if I saw it at $2 or $3, I'd buy it. I'd actually buy Tattooed Chef. I actually would, because I am, well, scratch that. I still probably wouldn't, because I don't want a 10% rate of return.
Yeah.
But I'm showing the audience what you can expect. If you just want a 10% rate of return, the growth rates can come down a bit. If I wanted a 15% rate of return, I got to go past 60. That's too much for me. So that's kind of where I stand. If I want to beat the market, I got to assume too much. And that's an assumption, right? There's no safety in that. There's zero safety in assuming anything. And that goes back to the comment we had about price targets versus what we're doing here. We're not giving price targets. We're giving buy prices that we would be buying based on assumptions. Price targets are a whole different thing. Price targets include sometimes momentum and also what people were willing to pay for it. So multiple expansion. Multiple expansion is like, how do you know what people are willing to pay for something? You don't know that. That's completely an assumption. So that's where I'm leaving off with this. Tattooed Chef seems like an interesting company. What we saw from the CEO's actions is he actually wants long-term survival of this company. He's heavily invested in the company. That's not what we're questioning here. Simply what we're questioning is the price. The price, I think, you have to assume too much. And I don't think some of these things are going to manifest the way people think they are. If you believe something like this or something close to this, and it happens, then that's what you can expect. Okay, but that has to happen. You can't expect it and then not happen. Then you're like, why didn't I 10x my money? And I forgot to put this as 27.1. Yeah, that's where I'm at with this, Austin. Any closing thoughts?
Nope. Well, so if you guys have really enjoyed what you've seen here today, if you've enjoyed our comprehensive due diligence videos on our Capital Mindset show, please be sure to like, comment, and subscribe. And also please share our video. That really helps out our channel a lot. And so we're your hosts, Austin and Fabio. We hope that you guys have a fantastic day today and you really like what you've seen here today. And we look forward to seeing you guys later. Take care.